Hello and welcome to Street Smart. If you want to learn about how to be smart with your money and learn about stock market investing, you are at the right place. In this video, we are going to cover fundamental deal down for a value like tool for value investor. So, as you know that more than 10,000 stocks are listed on US and Indian stock markets. It would take a lot of time for fundamental analysis for every stock. The fundamental deal down is a tool for a long-term value investor you can use to quickly know if the company stock or share are trading at attractive price in the market and which require further in-depth fundamental analysis before making a final decision. So let's start it. So fundamental deal down, you need to these are the few information they would be needing, which is the stock name, business overview. Like it should not be more than two line because value investor strongly believe that the company which they understand, like they are easy to able to explain the company model or business model in just two lines, then only they make a investment decision. And the market cap is the total value of the company if anyone wants to buy whole company. So economic mode, as we all know, so we would give a rating from 1 star to 5 star, 1 being narrow and 5 being wide. So what are the different way we can basically the source of mode? So one would be network asset. So network effect, the value of product or service grow as it user base expand. For example, product that Apple and Microsoft selling, they have a huge network effect. Then there is a switching cost, which is basically if a customer want to switch to new other vendor or supplier, it would be very difficult for them. For example, kind of a company using a ERP system, that is enterprise resource planning tool, that is, for example, if they are using Oracle and if they want to switch to a SAP ERP, then it would be very difficult because a lot of technical expertise would require and a lot of time and money would be consumed because kind of ERP has a lot of information. And not only we need to kind of integrate, we are able to plan the current manufacturing products, or kind of it also has a historic data, so we need to be very careful if we are switching in those cases. So Oracle definitely has a switching cost advantage or a source of economic mode. Intangible asset would be brand recognition, patent and regulatory license. They are called intangible assets. And yeah, like many big company like Google and all that, they have a huge patent and regulatory license. So yeah, and definitely they have good brand recognition as well. Cost advantage is they able to ability to produce product or service at a uh, lowest price, but they are easily able to sell them at a competitor's price. That is called cost advantage. Definitely we can say all Walmart, because it has huge network of retail and it is able to manufacture at a very least price and still sell at a cheaper price compared to other retail stores. And efficient scales would be market limited in size, potential new customer having a little incentive to enter, because doing so would lower the industry return below the cost of capital. For example, SIM card business or mobile card business, right? So market is saturated, right? They, in order to acquire new customer, it would be very difficult for them, because already everyone has a SIM card and they have a number, right? Kind of, which they not change that often. And for the new player, it would very difficult to enter in the business. And here are the few KPIs that we would be looking. First is P ratio, which is price per earnings ratio. So what is P ratio? So here I have a small chart where we can understand very quickly. So P ratio is the stock price by earning per share, that is EPS. What is EPS? EPS in net income by number of total share outstanding. It is like, so as we all know, there are a number of shares trading in the market, and for each single share, there is a earnings associated with the net income of the company that we call as EPS, and price ratio is like how expensive the current stock price is. We can know from price ratio. What is the average EPS growth rate? That is like taking current EPS divided by EPS before 5 year and my subtracting 1 to get the growth rate and into 100, then we divide by 5 to get average yearly growth rate, and it should be about 12% because currently we all know that indices like S&P 500 and other major index like Nifty 50 or Nifty 100, they give a good return of about 10 or 11% annually. So yeah, we should expect average growth rate should be above 12%. PEG ratio is the P ratio divided by average EPS growth rate. It should be less than 1.5. And we have price ratio by free cash flow, that should be market cap or capitalization divided by free cash flow. And free cash flow is calculated by operating cash flow minus capital expenditure, and shareholder equity, that is assets minus liabilities, and it should be greater than 0. Return on invested capital is equal to net operating profit after tax, NOPAC, and invested capital. So NOPAT can be found as operating income into 1 minus tax rate. Invested capital is equal to short-term plus long-term borrowings plus shareholder equity. So yeah, it should be greater than 10% for a good company you invest. So with that, we would go over one example. So we need all this information that is for Microsoft. What is the stock price? Like we can search here. Here the current price is 376. We would round it up. Current EPS we can find from the current financial statement. We can go here from Google and here annual report, and then we just need to scroll down, and find income statement. From there we can get that information. It would be under quantitative. It would be under quantitative and qualitative disclosure for the market risk. And there is a financial statement and supplement data, the income statement. Here we have a net income, right? And there is a total number of share outstanding that we also have. The EPS also is calculated. We always take the diluted one and we take for the current year. So it would be 9.68. Then we find EPS 5 years ago. So we can go here and search for, this 2023, 18, kind of. From 18, the same way, go down, search. 2018, the EPS was 2.13. So how do we find the 5-year growth rate? So that would be this divided by this minus 1 and be constant. So that is the percent, and this would be divided by 5 because we are taking 5-year difference. So yearly growth rate, average growth rate was 71%. So what would be the current P? It would be the stock price divided by EPS. That is the P. PEG ratio is nothing but price divided by growth rate. So this is very high because it is considering 70. We would just do 100. So yep, PEG ratio. Earning before taxes. How do we find the earning before taxes? So we can go here and there would be earning before income taxes. This is for 2018. we need to find for 2023. So earning before income taxes is 89.31. So everything is in millions. So it would be divided by 1000, that is billions at 89.311 billion. Income taxes was, this is the taxes that they paid. This tax rate would be this divided by this one. So operating income we can find from here. There is operating income 88.55. So yeah, 1 minus short-term borrowing that can be found from balance sheet here. So this is asset, this is liability. Here you can find information for that one. So we have information like long-term debt we have is 41.9, right? Shareholder equity you can find from here. So total shareholder equity is 206. Invested capital, before going to that, the short-term borrowing is nothing here, right? We cannot see anything. So we would consider long-term debt is here, short-term income tax on revenue. Thank you. Question for, okay, 0. Then invested capital would be this plus this plus this, and yeah, ROIC would be opaque, no PAT divided by invested capital 20%. So yeah, fundamental deal down for Microsoft. So as we see, the stock name is MSFT, and business overview, like we all know that Microsoft provides the Office 365 solution, which is like in which they include Excel, Word, and Outlook, etc., which is mainly used by very many corporate companies, as well as it also provides the operating system, that is Windows. And whenever any laptop manufacturing company or PC manufacturing company like Lenovo or HP, Dell mm, provides sells a laptop, they have installed Windows, and some kind of royalty is paid to Microsoft for installing that operating system, that is Windows. And also it owns different subsidiaries like micro LinkedIn, as well as it recently acquired Activision Blizzard, ChatGPT, as well as also it has um, owned the Azure DAO cloud. And market cap, if we see, it's around 2.7 trillion. In economic mode would be 4.5 out of 5, because uh, it is entering the new sector, that is cloud, and it doesn't have a cost advantage in that sector, because there are few major big player in that sector, that is Amazon and Google. So for that reason we would give 4.5 out of 5. And metric, if we see, it passes all or met the expected range for 4 of the metric out of 6, and 2 metric where it doesn't met the expected range is P ratio, that is price to earning ratio, it is 38, which is very, it is too high. That means if you buy the Microsoft stock based on today's earning or recent earning, it would be 38 times you would be paying the price. And price to free cash flow is also very high, 47%. So overall we would give 4 star out of 6. And if you believe or think that 71% of the growth is going to be sustained for a long period of time, then you should consider doing in-depth analysis before investing in the stock. And yeah, thank you for watching this video. Please like, comment, and share, and subscribe to the Street Smart if you find this video helpful.